All right, what's going on, everyone? We are picking it up here in chapter 3. We're about halfway through this deck. We are starting to talk about disclosures, right? So, we talked about the financial statements, the balance sheet specifically. One thing to be aware of is that normally for publicly traded businesses, there's going to be an annual report. Typically, we're talking about a 10K, right? In that 10K, you're going to see the four financial statements, right? The balance sheet, the income statement, the statement of cash flows, the statement of owner's equity. But there will also be a lot of other items that go with it, right? So we're going to look at those financial statements, but there will also be kind of a story or a background that goes with it, more information that basically discloses or lets third party investors know about the overall health of the company, right? The who, the what, the when, the where, the why, the how. If a reasonable third party investor would want to know about it, we would have to disclose it, right? So we talk about disclosure notes, right? It says explain data presented in financial statements themselves or provide information not directly related to any specific items in the statement. So here's some kind of examples of what you would see. So sometimes they're kind of like clarifying marks or they provide more detail, what you can't obviously pick up when looking at the financial statements, but somebody might want to know more about that. The one thing we will see, right, the kind of big footnote or area in there is this summary of significant accounting policies. This is typically the starting point, and it really gives a background for how we performed our accounting when preparing these financial statements. We basically applied GAAP, right? We use this, we use that. How did we account for our inventory? We use LIFO, FIFO. How did we depreciate our assets? We use straight line, right? So all of those kind of rules and policies, right? It gives a background for the financial statements that we prepared. Okay. Other things, right? Another like disclosure note would be a subsequent event, right? So these occur after the fiscal year end, right? So maybe there's 12/31, right? The end of the financial statements, we capture everything in there, but there's some type of subsequent event that happens there, but before we actually issue the financial statements. So here they are, right? The four financial statements. We release them on this date, they reflect that time period, but something happened intervening. So maybe there was issuance of debt, some type of business combination, we sold significant assets, there was an outcome on a contingency, but these are again something a reasonable third party investor would want to know about. Likewise, this other kind of catch all, right? Noteworthy events. So related party transactions, errors or fraud, any illegal acts, right? Maybe, for example, off the top of my head, like Meta, for example, they got in trouble because of misuse of client information and kind of privacy data laws on there. They would have to disclose that, among other areas, in those disclosure notes. Okay, so you can look at that guy right there. We also have the MD&A, right? The management discussion and analysis. This talks about things like significant events, trends, and uncertainties relating to our operations, liquidity, capital resources, off balance sheet arrangements, right? We can't like hide stuff off the balance sheet. We have to disclose that in the notes, and then any critical accounting estimates, right? The MD&A is kind of like, here's how we performed for the last year. Here's what we think is going on, right? So it's kind of like management speaking to you directly, telling you about like the story of the business over the period, right? Where they're at, where they're going. In this framework, right, we do have to be aware of management's responsibilities, right? It says here management prepares and is responsible for financial statements and other information in the report. It asserts that the responsibility of management for the information contained in the annual reports, as well as an assessment of the company's internal control procedures. Corporate executives personally certify the financial statements per SOX. So what does this mean? Right, so Enron, right? Enron was essentially like a pump and dump scheme. They were a big publicly traded company. The top kind of management officials were aware of all of their kind of fictitious or fraudulent things they were doing. They cashed out all the stock, made a lot of money, and then eventually the house of cards came like tumbling down, and all the investors lost a lot of money. Whenever that happened, right, one of the things was Enron, like the CEO, the CFO, they kind of pointed the finger at the auditors, Arthur Andersen. They said, I'm not an accountant, right? The auditors should have caught these mistakes. I don't know what's going on here. The auditors, in distinction, pointed kind of their finger back at the CEO, the CFO. Look, we can only work with the information that's given to us. If you fraudulently convey it, right? So the outcome of kind of all of this is, look, right, now we have SOX, among other things, it says that management, you are personally certifying these financial statements. You are personally responsible for them. So you can't kind of bury your head in the sand and be like, I didn't know what was going on. Okay. Other disclosures you might see, right, related to compensation for those kind of top level executives, stock options. A lot of times they're very heavily compensated in that. So, SOX requires, among other things, in the SEC that we disclose these items. You can look at that MCQ there. A new kind of growing area is ESG disclosures. These typically are going to be voluntary as a general rule. There isn't like we have GAAP breathing down our neck telling us we must do this, but a lot of times companies still nevertheless do disclose these, right? So environmental, right, it might be a disclosure about how much emissions we use, how much gas or energy we use. Social disclosures, right? They include issues of interest to the broader stakeholders. So maybe like the gender pay ratio, our diversity ratio or gender ratio in the company. And then governance disclosures include the company's actions and policies related to division of power within the company. So maybe something like, do we have a policy or a rule in the company around these specific areas? Again, this is a new kind of growing field, a little bit squishy in the sense that, a lot of this can be hard to quantify, but it is something that investors, may want to know about. And whether it's good or bad, right, I'm not here to kind of tell you the politics of it, but ESG is a growing field, okay? Talk about the auditor's report, right? So say we have the business, right? I don't know. Let's just say we have Meta, right? Or I don't know. Let's just say McDonald's, right? Because you can't look at an M without thinking McDonald's. But say we have McDonald's, right? They issue financial statements. If they want to be publicly traded, right, they have to have an external auditor, right, like a CPA firm, audit their financial statements, right? So McDonald's is like, hey, here's my balance sheet, my income statement, my statement of cash flows, and my statement of owner's equity. The CPA, right, the external auditor, maybe they work at a big four firm, right? Maybe they work at a regional firm, but they look at these and they basically attest to their fairness, right? And they issue some type of report, right? It's almost like the deliverable back to the CPA or from the CPA to McDonald's is like a book report, right? Here is our auditor's report. And in that, right, we are going to give an opinion about these financial statements, right? It's almost like we give them a grade, right? We can give an unqualified with an explanatory or emphasis paragraph, a qualified, or an adverse or disclaimer. It goes from kind of best to worst, right? This is like A plus, if you've ever seen the Christmas movie where the teacher's like putting that on the board. Unqualified is the best, right? It's just like a clean opinion. Unqualified with explanatory or emphasis matter, we'll talk about. That might be like an A or a B plus. Qualified might be like a B or C, and an adverse or disclaimer is like an F on there. It's kind of a challenge. One of the things with this that is kind of you have to think about, right, is like if they're okay, yes, we need to be an independent auditor, right? We need to look at these and the public trusts us. But how independent can we be, right, when they're paying us these giant fees? If we say, hey, we're giving you an F, right, you can kiss those fees goodbye on there. So it's always this kind of tension with auditors, right? Like you have like one client, typically like the bank, right? Because like some of these companies need an audit if they go to a bank and they get a loan, or if they're publicly traded. Those are the two reasons for an audit. But you hate to lose the client because there goes the money. But does that make you biased at all when you give the opinion on there? So I don't know. Some countries do different, right? In some countries, they have government auditors who audit the financial statements. So they're not being paid by the company. The starting point here, right, kind of the best, right, the A plus grade, and you'll learn more about this in your audit class, right? This is an audit class, but is a clean opinion. So it says an auditor issues an unqualified or clean opinion when they have undertaken professional care to ensure the financial statements are presented in conformity with GAAP, right? Essentially, what we're saying is we're looking at these financial statements and we are saying that they are conform with and fairly present everything in light of the rules of GAAP, okay? The next one is the unqualified with an explanatory paragraph, right? This arises, it says here, circumstances where the auditor believes the financial statements are in conformity, right? So overall it's good, but, right, other important information needs to be emphasized to financial statements users, right? So this but, right, it's kind of like, I like him or her, but, right, that's always never good when you put the but in there. But other important information needs to be emphasized, right? So things like maybe lack of consistency, right? Look, they changed accounting methods from last period to this. It's hard to have some consistency on there. There's a going concern, right? Maybe they're gonna not be able to pay their debts, or there's some type of material misstatement on there. Other auditor reports. These are the ones you don't want to get, right? Like a qualified opinion, adverse, or disclaimer. Generally, right, these arise when there's non-conformity with GAAP, there's not enough disclosures, or there's some type of limitation or restriction on the scope of the audit. These are like rarer, right? Unless there's like some like really kind of major issue going on, they tend not to be issued, but it's possible in there. You can look at that MCQ. We talked a little bit, we're continuing to talk about the balance sheet, right? It says here, investors and others use information that companies provide to make decisions. Users are most interested in the outlook of the future. And in this way, right, if I'm an investor, like a shark or something, I care about default risk and potentially operational risk, right? Default risk is the risk the company won't be able to pay its obligations when they come due. And operational risk essentially relates to how a company can withstand various elements and circumstances that might impair its ability to earn profit. So let's talk a little bit about these, right? So we care about some type of risk, whether it's I won't get my money back, where the company won't survive if there's some type of operational issue. And among other things, right, when we are looking at these financial statements and we care about this risk, we will perform financial statement analysis, right? So there will be comparative financial statements, right? We may be able to look at year one and year two, right? We can see their assets did this, their liabilities did that. Oh, their income went from 1,000 last year to 10,000. Hey, this is a company I want to invest in. We can perform in this framework horizontal analysis versus vertical analysis, right? Horizontal, right, is kind of left to right. And then vertical on there is up and down, right? So let's talk a little bit about that. Right, so horizontal analysis might be something like we're looking at year one versus year two versus year three, right? It's comparing the financial statements essentially over time. In distinction, vertical analysis might be within a single year, right? We're looking at just year one, right? We'll look at maybe our total kind of sales revenue or our income on there, and we'll break it out between other items, right? What percentage of this was our gross profit versus what percentage of this was our cost of goods sold, right? So we're looking at internal to a single year, whereas horizontal analysis tends to be looking over multiple years, right? So we can do those with the financial statements. Another is ratio analysis, right? Ratios are kind of a quick hand way to pick up financial statements and figure out some information, right? So it's kind of like with fantasy football, right? You would have a QBR rating for a quarterback. You don't need to know much about football to know that, hey, if somebody has like a 99 rating for a QBR rating, that's pretty good, right? Versus maybe somebody who has a 70 on there. So it's a quick hand way of evaluating. Ratios will look at different things, right? So we're going to look at, among other things in this chapter, liquidity and solvency ratios because our focus is on the balance sheet. But there's definitely ratios that look at more of like the income statement and performance and things like that. Okay, so there's different things they're kind of getting at with ratios. And the final point I'll kind of talk about ratios before we hop into it is, they don't make sense in a vacuum, right? I need to know if your kind of current ratio is a 1.25. I don't know if that's good or bad without knowing what your competitor's current ratio is. So I kind of need other things to compare it with. In a vacuum, it's not that useful to me. Okay, so you can look at that MCQ. Let's first talk about liquidity ratios, right? So this is going to be more short-term focused. It refers to the ability of the company to convert its assets to cash to pay its current obligations. We have the current ratio in the acid test ratio, and we really have that kind of more short-term view. Again, as the analogy, can we pay our bills this week, this month? That's what we're looking at in the company. Let's start with the current ratio, right? So the current ratio essentially is going to be your current assets over your current liabilities on there. Typically with the current ratio, right, if it's greater than 1, that shows that we can pay that short-term debt, so that's a good thing on there, but you don't want it to be too high because then maybe you're not using your current assets as wisely as you could on there. So we have an example here, right? We have Nike, they reported current assets of 25, current liabilities of 92. Hey, our current ratio is 2.27. Which basically indicates that the company has $2.72 of current assets for each $1 of current liabilities. That's a good thing, right? For every dollar I owe, I have $2 in short-term stuff. I can definitely pay it off as it comes due. All right, so that's the first one, the current ratio. The next one is the working capital ratio, right? This is going to be your current assets minus your current liabilities. The thing with this is, right, it's not like as a percentage or an amount, it's just a raw kind of dollar value, right, an absolute dollar value that shows us how much we have left over, right? So it says, for example, Nike's working capital in millions is 15 million. This amount is computed as 25 current assets minus 9 current liabilities, right? That leftover on there, the 25 minus the 9, you round it here, I mean, it could just be 16. This is what is left over, our working capital that we can use to work with, right, on a day-to-day basis. So yes, we know here, if we can pay our short-term debts, that's great with the current asset, or the current ratio. The working capital ratio is just a different take on it. Here's how much we have in raw dollars. That's our working capital, okay? How about the acid test or quick ratio? Right, so what we do here, it says it provides a more stringent indication of a company's ability to pay its current obligations. So it's kind of like the current ratio, but we are going to be even more narrow, right? The numerator, right, is going to exclude inventories, prepaid items, and restricted cash, right? Because if you think about it, right, we can't really use these anyhow because they're all tied up and stuff. So if we're looking at the short-term kind of items of the business that we can use to pay off our short-term debt, we can't use those, right? It's going to be hard to access that restricted cash. That inventory we'd have to sell, right? So the numerator, we're going to exclude certain items, but we're also, as it has here, include, right, unrestricted cash, short-term investment, and accounts receivable. These kind of quick assets that we pretty much can treat almost like cash, or that we can access more easy. So we're really taking the current ratio and refining it on there for purposes of the acid test ratio. So that's what we're doing here for this one. So it says here Nike's quick assets in millions are 14,806, right? Namely, we have our cash, our short-term investments, and our accounts receivable right here. and we take that, right, we divide that by our current liabilities. Okay. So this is again just showing that, like, hey, we have to see this stuff. It's not good in a vacuum, right? We have to know about the other companies to see if these are good or bad, these current and kind of acid test ratios, right? That's the industry standard. Here's where we're at. Hey, we're above the industry. That's a good thing, right? That's the company I might want to invest in on there. So it says here, which of the following transactions would increase the liquidity ratios? So borrowing cash by signing a 3-year note, right? Cash increases, right? So we would have potentially our assets go up while our current liabilities remain the same, right? So it's still the same. Down here, if you have any type of ratio, right, you make the numerator go up, the ratio will go up, right? So when we talk about any ratio, kind of just as a pause point or moving forward, if you have the following, right, the numerator goes up or the denominator goes down at an overall kind of item there, then the ratio will go up. If the reverse happens, right, if the numerator goes down or the denominator goes up, the ratio goes down. It's just a function of like kind of simple algebra on there. Okay, so those were our short-term ratios, our kind of liquidity ratios. Can I pay my bills the next month? We had the current ratio, the quick ratio, acid test ratio, and working capital, looking at different things. Solvency ratios are more long-term, right? We have the debt to equity ratio and the times interest earned ratio. Are we going to be good over the next 5 years or 10 years with our debt? The first one here is our debt to equity ratio, right? And essentially all we do here is our total liabilities over our total stockholders' equity, right? It's just that, right? It's going to be our debt over our equity, right? And if the ratio, right, the higher the ratio on this, the worse it's going to be, right? The higher the risk, because we're pretty much have like too much liabilities going on there, right? There's going to be an issue if, we're too highly leveraged like that. So pretty straightforward, right? Our debt to equity, nothing kind of too hard there. How about, and again, this is just showing like here's the industry average, here's where we're at. How about the times interest earned ratio? So here's the equation, right? The times interest earned. It's our net income plus our interest expense plus our income taxes over our interest expense. A lot of times it's used with the debt to equity ratio. And overall, what we're looking at here, right? So it says to remain solvent or take on more debt, a company needs to have funds available to pay interest charges. So we're trying to see like, okay, we're looking at long-term debt. That's the focus here, long-term. If you have long-term debt, there's going to be interest on there. The times interest earned ratio is really looking at kind of the, our income, a form or modification of our income and that interest kind of expense. What's the relationship between those? And it says if income is many times greater than interest expense, creditors' interests are more protected than if income just barely covers the expense. So it's just a fancy way of saying like, look, if you make a lot of money and it's way above what your interest expense is, that's a good thing. You'll be able to pay that interest expense. If you make less money and you have this big interest expense, you might not be able to pay it. Okay? So here's kind of the example. You can look at that, right? They're telling us our net income, our interest expense, our income taxes, right? There's our income before interest and taxes. That's 64.92, right? Over the 291, our times interest earned ratio would be 22. Okay. It says here, right, relationship between risk and profitability, right? While there are default risks associated with borrowing, a company can use those borrowed funds to provide greater returns to its shareholders. This is referred to as favorable financial leverage and is a very common but risky business activity. What are we getting at here, right? Essentially, one of the things is, look, if you're going to be riskier, right, this investment, if I'm going to put my money in there, there needs to be a relationship between the return that I'm going to get, right? Generally, the riskier the investment, I expect a higher return, okay? The last thing we'll talk about is segment information, right? So this says it facilitates the financial statement analysis right? So we're analyzing these financial statements of diversified companies, right? So we basically take this big giant company, and when kind of reasonable to do so, we chunk it out into different segments, right? So it says, how do we know what an operating segment is? It's determined by using a management approach. It's evident from the structure of the company's internal organization. If it's a public business entity, it's formally defined by the following characteristics. It engages in business activities from which it may recognize revenues and expenses, whose operating results are regularly reviewed by the CEO, and for which discrete financial information is available, right? That's a mouthful. What are we talking about here, right? We have this big, messy business, right? Maybe we want to see how different lines, operational lines, are doing, right? So maybe we have Disney, for example, right? If you looked at their kind of financial statements, right, it would be hard to kind of break that out in your head, right? How much of this is coming from their movies? How much of this is coming from their theme parks, right? So they may break out, right, their financial statements, if you were to look at it, into maybe like an entertainment segment. They could have, I don't know, maybe a sports segment. I know that they, own ESPN, right? So that's kind of different if they have live sports that they have versus like Disney Plus. And then obviously, right, with Disney, they would have maybe like an experiences segment where it would be like their theme parks and stuff like that. It would, like, the big thing with this, right, is it would be relatively easy to find discrete financial information for this. We could track just the revenues and expenses or the assets, the liabilities of the theme parks. We could do that for the movies and things like that with it. So that's one way you could do it. Another could be like geographical, right? If you had, for example, like Apple, they might break it out by their America sales, their Europe sales, so on and so forth, okay? So it says what amounts are reported by an operating sector or segment, sorry. There's certain required disclosures, right? Factors used to identify the reportable segments and the title position of the chief decision maker. Obviously, information about the profit and loss of that segment. We need to reconcile from the segment to the overall financial statements any interim period information, right? So here's, for example, right, a company, right, they would break it out in their segments, right? We have, a laboratory company. Hey, we have pharmaceuticals, we have nutritional products, diagnostic products, medical devices, right? This would be kind of a handy way as an external user to see this information and say, okay, how are we doing just in our pharmaceuticals, okay? It says here, US GAAP requires reporting certain geographic information, namely revenues from external customers, domestically attributed to foreign countries, so both of those, and then long-lived assets, long-term customer relationships, and other policies, both domestically and attributed to foreign countries. Again, the last thing to be aware of is information about major customers, right? This helps the financial analysts in providing information concerning the extent to which a company's prosperity depends on one or more of the major customers. At an overall level, this is something we care about, right? If you are selling most of your stuff to one customer, you need to disclose that because a reasonable third party would want to know. Because if you lost that customer, that would not be good for the business, right? So we have this kind of 10% rule, right? If 10% or more of the revenue of an entity is derived from transactions with a single customer, then the entity must disclose that fact, right? So we got to be aware of that. Certain major customers, 10% or more, we need to make sure that we're letting the investors, the lenders, and the creditors know about that through use of disclosure. Okay, so that's going to be it for chapter 3. We will see you in the problems.